1972, 1990, 2008. These three numbers are not advanced economic theory. For many Americans, they are memories. They are anxiety. They are the moment you turn on the TV and hear words you never thought you would hear. They are the days you walk into work and feel that something has changed. They are the nights you sit at the dinner table wondering whether your job will still exist next month. About every 2 decades, the United States goes through a major shock, not a mild slowdown followed by a quick recovery, but something powerful enough to permanently change how an entire generation thinks about money, work, and the future. And now, when people look at those 3 dates, a question quietly forms in the back of their minds, whether they dare say it out loud or not. Is 2026 becoming the next stop, or is this all just coincidence? Are these stories we stitch together after the fact, trying to impose meaning so we feel more in control? But if you are old enough to remember 2008, if you remember how it felt when things began to break, then you know this. Major crises never appear out of nowhere. They do not arrive overnight. They do not happen because of one single event. They are prepared quietly over many years, while most people still believe everything is fine. Before we go any further, let me be very clear about one thing. If you think this is just another fear-based video meant to scare you, you are free to stop watching right now. No one is forcing you to listen. But if you are still here, if you keep listening, then somewhere inside you, you already understand something important. History does not repeat itself because we believe in it, but because we forget it too quickly. This video is not meant to cause panic. It is meant to help you see what most people only recognize when it is already too late. The real issue has never been that people don't believe in cycles. The issue is that every time a cycle ends, people believe they are finally safe. They believe this time is different. They believe the system is smarter. They believe banks have learned their lesson. They believe the government will never allow this to happen again. Before 2008, millions of Americans believed exactly that. They believed housing prices could only go up. They believed that if something went wrong, the financial system was large and sophisticated enough to handle it. They believed depressions were relics of the past. You may not have said it out loud, but you probably believed it too. Let's go back to 1972. At the time, people said the recession was caused by the oil crisis. Oil prices surged, costs exploded, businesses collapsed, the economy fell into recession. That explanation sounds reasonable, but if you look deeper, if you look past headlines and into the data, you see something else. The U.S. real estate market had already begun weakening. Loans were becoming harder to service. Financial stress was quietly building. Oil was simply the match that lit a pile of dry wood that had been accumulating for years. 18 years later, in 1990, the pattern repeated. This time, the blame fell on geopolitics, the collapse of the Soviet Union, a changing global order, international instability. But again, if you look beneath the surface, the story looks familiar. Real estate weakened first. Cash flows tightened. Borrowers struggled. When an external shock arrived, the system no longer had the strength to absorb it. Then came 2008, another 18 years later. This time, the name Lehman Brothers dominated headlines. Many people believe Lehman caused the financial crisis, but anyone who lived through that period honestly knows the truth. Lehman was not the cause. Lehman was the final domino to fall. The real cause was far simpler and far more uncomfortable. Americans could no longer afford their mortgages. Housing prices stopped rising and began to fall. Subprime loans defaulted, and when the foundation collapsed, everything built on top of it collapsed as well. 3 crises, 3 different stories, but the same starting point every time. Real estate, not stocks, not banks. Real estate. In every cycle, real estate falls first. Banks absorb the next shock, and only then do jobs and consumer spending collapse. Ordinary people don't feel a crisis until work disappears, income vanishes, and the stability they spent decades building suddenly becomes uncertain. Now, set history aside for a moment and look at America today. Don't look at stock indexes. Don't listen to reassuring speeches on television. Look around you. Do you see empty office buildings? Do you see downtown areas that feel quieter than they used to? Do you see small businesses closing and familiar storefronts disappearing? National office vacancy rates are now around 20%. In major cities, they are far higher, and commercial real estate default rates have already exceeded post-2008 levels. These are not forecasts. These are not opinions. These are real-time numbers. But the real problem isn't vacancy rates. The real problem is cash flow. Real estate does not run on hope. It runs on cash. No tenants means no income. Lower rent means debt becomes unpayable. Meanwhile, taxes, maintenance, and operating costs continue, and banks do not wait. That means every day you wake up, you are losing money. Not paper losses, real losses. When that continues long enough, choices disappear. You can drain your savings. You can beg the bank for extensions. Or eventually, you do the most painful thing of all, you walk away. And now, many people ask the obvious question. If things are this strained, why hasn't the U.S. economy already collapsed? Why hasn't everything broken yet? The answer lies in fixed-rate debt. During 2020 and 2021, interest rates were historically low, 2 to 3%. 5-year terms were common. It was like injecting the entire system with anesthetic. Assets were weak. Cash flow was strained, but the pain was delayed. People could endure. They could stretch. They could survive a little longer. But anesthesia always wears off. Loans written in 2020 and 2021 begin maturing between 2025 and 2027, with the peak in 2026. At that point, borrowers don't just face interest payments, they face principal, and the question becomes brutally simple. Where does the money come from? Interest rates today are far higher. Asset values are lower. Banks are cautious. Refinancing has become extremely difficult. Even if the Federal Reserve cuts short-term rates, it cannot force banks to lend. It cannot force markets to reprice assets higher. When credit contracts, the real economy absorbs the blow. At this point, the crisis stops being about large property owners. It spreads quickly. Banks tighten lending. Small businesses lose access to capital. Layoffs begin. Spending falls. The spiral accelerates. If you lived through 2008, you remember this feeling. At first, they said it was a financial problem, then a housing problem, then a banking problem, until one day, you or someone you know lost their job, and theory became irrelevant. History shows us something uncomfortable. The greatest fortunes are not built during expansions. They are built after crises, when assets are liquidated, when leverage is destroyed, when most people are simply trying to survive. Opportunity does not come from predicting the exact day of collapse. It does not come from panic. It comes from standing firm, from having liquidity, from understanding what is actually happening. And this is what very few people truly grasp. The Fed does not intervene before the system suffers enough. The Fed does not print money to protect the middle class. The Fed prints money when the system is on the edge of collapse. And when QE finally returns, asset prices will not rise from the top. They will rise from the bottom. So the only question that matters is this. When that moment arrives, where are you standing? Trapped in debt, clinging to an unstable job, paralyzed by fear, or holding liquidity, clarity, and the ability to act? That is what people mean when they talk about a once-in-a-generation opportunity, not because it is easy, not because everyone can take advantage of it, but because it only appears when most people no longer can. And this is where most people misunderstand what opportunity actually means. Opportunity does not show up when the economy feels good. It does not appear when everyone feels confident, optimistic, and fully employed. Those are the moments when prices are already high, risks are already hidden, and leverage is already stretched. Real opportunity appears only after confidence is broken. It appears when people are forced to sell, not because they want to, but because they have no other choice. It appears when debt becomes unbearable, when refinancing is no longer possible, and when time runs out. And history shows us something uncomfortable but very consistent. The biggest transfers of wealth never happen during expansion. They happen after contraction has done its damage. This is why understanding timing matters more than intelligence. Many smart people were wiped out in 2008, not because they were wrong about the long-term future, but because they were early, over-leveraged, or psychologically unprepared for volatility. They believed that because the system should be saved, it would be saved immediately. They underestimated how long pain can last before intervention actually arrives. And this is where 2026 becomes critical. Not because it is a magical year, not because numbers repeat themselves out of superstition, but because it is the point where financial reality collides with political constraints. By then, refinancing pressure peaks, debt maturity peaks, and tolerance for losses reaches its limit. At that stage, policymakers no longer control outcomes, they react to them. Only when the system is close enough to breaking does intervention become politically acceptable. Only then does large-scale liquidity return, and when it does not lift everyone equally. Liquidity does not save the middle class, it saves balance sheets. Those who survive the contraction with liquidity, patience, and emotional control are the ones positioned to benefit from the recovery, not because they are smarter, but because they are still standing. This is why preparation matters more than prediction. You do not need to know the exact month or quarter when stress peaks. You need to know where you stand when it does. Are you dependent on constant income? Are you dependent on refinancing? Are you dependent on asset prices staying elevated? Or do you have flexibility? Do you have liquidity? Do you have optionality? Do you have the psychological resilience to wait while others are forced to act? Because when the turning point finally comes, it does not feel like relief. It feels like chaos. Prices do not bottom when headlines improve. They bottom when fear peaks and hope disappears. And by the time confidence returns, the opportunity is already gone. This is why the next phase will not reward optimism. It will reward positioning, not speculation, not leverage, but patience. The people who emerge stronger are rarely those who tried to outrun the cycle. They are the ones who understood it and stepped aside before it turned. If you are still listening, it means you are serious about understanding this cycle. And if you don't want to forget this when reality begins to catch up, save this video, not to support me, but so you can return when what we are discussing becomes visible in everyday life. The 18-year cycle does not require belief to unfold, but if you understand it early, 2026 does not have to be a catastrophe. It can be the turning point that changes your position in society.